I think there's a lot of people that don't understand what they're putting their money in when they're using brokerage apps and retirement accounts. And this video is just to kind of elaborate and give a certain foundation on how these work and how they get taxed. Because it's really important to understand the tax implications of your investments, and because in terms of how much money you're actually going to get and keep in the future, it's going to be really important to have a solid tax strategy when you're investing and be able to maximize on that. And this is what this video is going to focus on, and how to basically lower your taxes and maximize your returns. If it's the first time you come across my channel, my name is Pascal Manigat. This is a financial ownership podcast, and I typically talk about different financial topics and financial products and concepts so people can maximize their financial situation and have more money for whatever financial goals that they have. So let's go on to the video. I'm gonna share my screen and I'm gonna go through a few slides on how you could potentially really reduce the amount you pay in taxes and really optimize your financial plan. So make sure you stick until the end of this video because you're gonna get a lot of value out of this. And in the end, I have a particular concept that you might not have heard before on how you can amplify the performance of your investments without actually taking more investment risk. So make sure you watch until the end of this video and get all the information that you need to make a solid financial plan. So I actually think that a lot of these apps are actually very good. There's a lot of different features in terms of Roth accounts and brokerage accounts that you could create with Fidelity, Vanguard, and Charles Schwab. And there's a lot of low-cost alternatives than using expensive investment advisors and all these type of things. So a lot of these brokerage apps have a lot of good features to it, but it really doesn't do any good if you don't know how to use and optimize it and lower risk ways to invest in these apps. So that's going to elaborate on a little bit on how you can do that. So sometimes people, they kind of think about just investing in individual stocks. They might think of, say, Apple, Amazon, or maybe you're trying to be a little bit more risky and look for smaller cap companies which have higher potential upside, but at the same time they have more risk associated with it. But if you want to just keep it simple and just get average returns from the stock market, what you can do is buy an S&P 500 fund. And the S&P 500 fund returns about 7 to 10% historically. So if you look around 1926, that's what it's been doing. And you could get this with basically any of those apps that I was talking about before. You can get that with Fidelity, you could get that with Vanguard, Charles Schwab. A lot of these apps have that. And the good thing is you could get these type of funds in retirement accounts as well, whether it's a Roth account or a traditional IRA or whatever retirement account you choose to use. I think Roth accounts right now make the most sense, but depending on whatever strategy you want to use, a lot of those apps have the ability for you to use any retirement account that you want. Or you can just use a regular brokerage account, which maximizes the liquidity of your money. So the thing is, it's not fixed. So whenever you invest in an S&P 500 fund, it's never fixed income. So it's not going to be a guaranteed 7 to 10%. You're taking risk when you're putting your money in S&P 500 fund. But think about it like this. A lot of people forget. When they have a job, they might be getting paid 50, 60 grand and their income doesn't fluctuate. But businesses' income always fluctuates. They never make the same amount of money every month. They have a general idea what they're going to make at the end of the year, but it fluctuates. So that's why when you think about investing in a stock market fund, you're investing in the top 500 businesses in the US essentially. And yes, it fluctuates a lot because the business valuations fluctuate and all these type of things. And then there's news and all these type of things that fluctuate the stock market, interest rates rising. But in the long term, the good thing is the S&P 500 has proven to sustain over time and has increased in value. So even though we had those short-term crashes, you may have heard a few weeks ago there was a harder crash in the stock market. But historically, the S&P 500 has a good track record. And one thing you want to keep in mind when you're investing in these funds is something called long-term capital gains versus short-term capital gains. So short-term capital gains is when you sell, whether it's a stock market asset, whether it's an individual stock, an index fund, or whatever it is. It's when you sell under a year. So the thing is, let's say you're in a 24% tax bracket. If you sell under a year, you're going to get taxed at 24%. So that's the thing is, whenever you sell short term under a year, you're going to get taxed more than otherwise holding it over a year. And over a year, you're considered a long-term investor. So you get taxed at long-term capital gain rates. So If you hold for over a year, you're going to get taxed around 10 to 15%, which is significantly less than selling it under a year, where you're going to tax at 24%. And one thing you have to realize is the stock market is risky in the short term, but safe in the long term. So the longer you hold, the more likely that you're going to make above the principal that you invested. So the stock market isn't supposed to be a short-term game. It's supposed to be a long-term game. And you just need to figure out ways to maximize your income to invest more into funds like these. So there's several funds you can invest in. There is VOO, which is the Vanguard ETF, which just gives you exposure to the overall stock market. There's SPY, which also does a similar thing. And there's FXAIX, which is one of the most low-cost index funds that I've seen. And the good thing is, if you're using an app like Fidelity, which gives you access to the S&P 500 through their index fund, they let you periodically put money in without you having to log into your bank account or anything like that. They have automatic deposits into the brokerage account, and you can invest into those funds. So that's great. And that fund has a 0.015% expense ratio, which is really good, because a lot of times when you look at actively managed mutual funds, sometimes they might have 1.5% expense charges or 2% expense charges. Doesn't sound like a lot, but if you're looking at having $100,000 invested in some type of stock market fund, 1.5% of that $100,000 is $1,500, but 0.015% of that $100,000 is only $15. And over time, that could be hundreds of thousands of dollars that you could be saving just by using a lower cost strategy. And especially if the risk you're taking is the same in that investment fund, there's no reason to pay those higher charges, especially if it's going to be a similar historical rate of return. So that's one thing you want to keep in mind. And one person who's a big advocate of investing in index funds is Warren Buffett. And I think it's a very simple strategy for a lot of people, because a lot of people, they're focused on life, work, and all these things, so they never really get to think about investments and all those type of things. So rather than paying an arm and a leg for investment funds, you could always use a simple strategy like the S&P 500. And one way to mitigate risk is something called dollar cost averaging. So this is another reason why you shouldn't worry too much about fluctuations. So a lot of times you can hear news media talking about fluctuations in the stock market. The stock market went down or whatever it is. Because the news media sells fear. But if you understand the way you're investing to lower your risk, it's a really big difference maker in terms of protecting the amount of money that you have. So let me explain. So if let's say, for example, there's a fund that you're investing in, just say ABC fund, for example. If you put $10 into ABC fund, and the stock is worth $10, so that fund is worth $10, month one. And month two, it ends up being worth $5. And you put that same $10 month two. In month three, the stock goes back up to $10, and you put that same $10 in month three. So a lot of people think in this scenario you would break even. But actually, you make money in this scenario. And the reason being so is because in month two, you put $10 into that fund, and you were able to buy 2 shares of that fund, and it went up the next month. So you actually made a 33% return. So as long as you're consistently investing, it really doesn't matter about short-term fluctuations, especially if you have a long time horizon. This changes when you're closer to retirement and things that sort. But generally, if you're younger, if the stock market fluctuates a little bit, it really doesn't matter, especially if you don't have a lot of money in your fund. Because if you don't have a lot of money in your fund, a monthly contribution is going to significantly lower your risk, even if the fund drops, because you're buying your shares, or you're buying those shares at a discounted rate. And if the stock market rises or that fund rises, that's going to end up increasing the value or the money that you have in total in that account. So as long as you're investing periodically, whether it's monthly, quarterly, annually, you're really lowering the risk of your investment. So that's one thing. As long as you're not putting one chunk of money and not contributing again, you don't have to worry too much about buying things that are overvalued price if you just use a strategy like dollar cost averaging. So this is a really good entry-level way for people to start investing. And sometimes people might ask, what if I put my money in the S&P 500 and it burns to the ground? Like, there's nothing left. So let me ask you a question. If the S&P 500 burns to the ground, which is the most influential companies, you think about Facebook, Amazon, Netflix, Tesla, Microsoft, all these top companies, if it burns to the ground, what do you think the American economy will be? And what do you think dollar would be worth? So the thing is, not taking a risk is a risk, because we all know that the dollar is going down in value. We see inflation is going at like some crazy amounts, like 8% last thing I've seen. Inflation is going higher and higher. So the thing is, you could not invest into the stock market or not invest into any sort of asset class and not take an investment risk with your money, but at the same time your dollar is depreciating. And you have to think about it. If the dollar can't buy the goods and services of these Fortune 500 companies, what is the dollar worth? It's not really worth anything. So the only thing that gives the dollar its value is the fact that we could buy the goods and services of companies like Amazon, Microsoft, Tesla, and all these other companies that are out there that we could buy the goods and services for. But if these companies no longer exist, the dollar doesn't have value. So the only reason it has value is because of these companies. And the thing is, another thing you want to keep in mind is about 80% of the U.S. economy are the Fortune 500 companies that consist of the S&P 500. So if you want to think about it, in the long term, it's not going to be that risky when you're putting money into funds like this. So we have bigger fish to fry if the S&P 500 falls to the ground, because the dollar isn't going to be worth anything anyway. So not taking a risk is a risk. So that's one thing you want to keep in mind. And one thing I want to talk about is the time horizon when it comes to investing. So if someone starts at 20 years old, invests $400 a month, and gets a 10% rate of return, and they do that until they're 60 years old, from 20 to 60, earning that rate of return, putting that monthly contribution, they end up having over $2.5 million in that account. But if they wait 10 years at age 30 and they do the same exact thing, they only end up with $900,000 about in their account. So the real thing is the earlier you get into investing, you're really going to be able to maximize on your returns, because you just have more time earning interest on your money versus if you start later on. So that's one thing you want to keep in mind is as soon as you start making consistent income, you want to have some sort of investment strategy. It doesn't necessarily have to be the stock market, but if you have a business that you're investing in, you have skills that you're trying to learn, or whatever it is, you want to make sure that you're in a position where you're always constantly investing into things that could potentially appreciate in value, whether it's the stock market, real estate, or your own personal knowledge. Make sure that you have some sort of investment strategy so you can make more money in the future. So the earlier you invest, the better. Just keep that in mind. So let's talk a little bit about retirement accounts. And like I was saying, the investment funds you pick matter a lot. And a lot of people don't realize that there's some funds that will charge you 2% annually. And there's other funds that will charge you like 0.08%, like not much. So what you pick in terms of your investment fund can be the difference between hundreds of thousands of dollars. So make sure that you either understand what you're looking at or you work with someone who does, to choose an investment fund, especially if you're considering investing in a fund for 20, 30 years or some extreme long period of time. So just understand, when you invest in tax deferred accounts like 401ks, 403bs, 457, etc., and there's some other accounts that like that, you lose liquidity of your money and there's unpredictable tax risk. So many people don't know how these accounts work. So the way these accounts work basically is they're tax deferred. So if I make $60,000 a year and I put $10,000 into a said 401k, now I'm getting taxed at $50,000. So I'm deferring that tax till later. So I could keep doing that, getting taxed at $50,000. So I'm lowering my current tax rate to increase my later tax rate. So I'm deferring taxes later on in the future. So let's say I keep contributing $10,000, keep contributing $10,000, and I keep doing that. I later on might have, say, $1 million built in that 401k. But when I take that out, that has subject to full income taxes. So even though there are stock market assets or bond market assets and other types of market-related assets that you're investing in, you get taxed at ordinary income rates, which is more than capital gains tax and more than any other tax you could pay. So that's the unfortunate thing when it comes to using tax-deferred accounts, is you don't get the tax benefit of long-term capital gains. You get ordinary income rates, which are the highest taxes you can pay. So you have unpredictable tax risks because you don't know what tax rates are going to be in the future. And if you look at current tax rates compared to what they've been in the past, there's a good chance that they can raise. No one knows the future, but you can look at the history of taxes to get a better idea. And you also lose liquidity a little bit you lose liquidity a lot actually. And the reason being so is because if you take out money from your 401k, you get penalized and taxed. So if you take it out under 59.5, there's a 10% penalty associated with it on top of income taxes. So you're going to be increasing your taxable income if you take money out, and it's going to be attached to your working income currently, and you're going to have to be paying penalties on it. So it really punishes you if you take out money from it. So you lose a lot of liquidity. But the good thing is there's other alternatives you can use if you want a little bit more liquidity. There's Roth 401ks and Roth IRAs. There's more liquidity, meaning if you contribute, say, $10,000 to said Roth 401k, you could actually take out what you contributed. So that $10,000 that you contributed is still liquid. But anything above that, if you accumulate, say, $11,000 or $12,000 that you accumulate, that extra $1,000 or $2,000 is gonna get penalized if you take it out before 59.5. So still limited liquidity, but at least you have some access to your money in case of problems and emergencies. And there's also less tax risk, because literally what you're doing when you have a Roth 401k, you're assuming taxes now. So that same example that I was using for someone that made 60 grand, that same person would basically assume that tax of they wouldn't defer that tax to later. They would pay taxes on the 60 grand and they would put it in this tax after account. Say it's a Roth 401k or Roth IRA. And as it accumulates tax free, and they could access it tax free later on. And they're not penalized and they're not taxed at anything because they already pay taxes up front. And that's the benefit of a Roth account, is when you save or you invest into a Roth account, when the money accumulates past a certain point and you take it out after 59.5, you don't have to pay any taxes on your money. There's still investment risk in these accounts, but it's a better alternative potentially than just using a said 401k or traditional 401k or 403b or any of those accounts which really restrict your liquidity. That's one thing you want to keep in mind. And like I was saying, when it comes to tax deferred accounts, the problem with it is that taxes are historically low now. So if you look at this part over here at the end where it says 2018, tax rates haven't changed from 2022 much. So you're looking at historically low tax rates in comparison to what it's been in the past. So that's one thing you want to keep in mind. You might be deferring yourself into a higher tax rate, and especially if you're deducting things like your kids' expenses and your home, some things that you might not have as expenses later on in the future, you might not be able to deduct later on. So you have to also keep that in mind, is when you get older and you get to the point where you want to retire, a lot of these expenses might not be deductible that you were deducting before. And just to give you a good overview, so this is like the investment accounts that people use. So they use brokerage accounts, they use retirement accounts, and use all those type of things. These are all great. You could use this as a way to get ahead in terms of investing in retirement and things of that sort. And these are what advisors focus on. So people need to know more about these things and understand these things, which is good. But the problem with that, it only focuses on what you could save and invest. So if you make $60,000 a year and you save $6,000, let's say you save 10% of that $60,000 you make in income. That's usually what's at least a good starting point, is being able to save and invest 10% of your income. But the problem is you're only saving 10% of your income. What about the other $25,000 to $30,000 that you spend every year after taxes? Where does that go? You don't really make any interest on it. And the problem with the way advisors show people how to save and invest their money is it just focuses on the discretionary, what they could save. But it doesn't focus on making interest and money on the money that flows out of their account every single month and every single year. So think about it like this. 10% on $6,000 is less than 3% on $30,000. So if you could find a way to capitalize on making 3% on $30,000, that will amplify and speed up the process in terms of reaching your financial goals a lot more than just focusing on your discretionary, which is that 10% on $6,000. What you really want to do is you want to be able to make on both, all the money that you're spending and your discretionary. And this is kind of what the strategy that I'm talking about can do in terms of amplifying your investments. So those are great investment vehicles to have, but to kind of mesh it all together, you want to be able to find alternative ways of saving than just spending through a checking account. And that's kind of what I'm going to go over a little bit about this. So if you look at what banks do, if you look at what major banks do, financial institutions, they save a lot of the money in cash value life insurance. And they even save more than money in cash value life insurance than they do in real estate. The reason why is they get 3 to 4% on those policies while they pay 0.06% in a savings account. So really, what is the point of saving in a savings account? There really is no benefit. If you could find a way to save in a cash value life insurance policy and do the same thing what the bank is doing, you could potentially capitalize on a lot of money. And you actually could make a spread on your expenses, so every time you're spending money, you actually can make money whenever you're spending. This strategy actually is about using an index universal life policy where there's a cap and floor of about 0 to 10%. So it's based on the S&P 500 where you're saving money in this policy, and based on the performance of the S&P 500, you could get up to 10%, but if the market goes down, you have a guaranteed floor of 0. So these policies earn an average rate of 7%. And the thing is, you could borrow from these policies at an average rate of say 4% and pay for your bills and expenses and really capitalize and maximize the performance of your investments. So just like I was showing you, having those investment accounts, the brokerage account, the retirement account, all these type of things, if you just change the way you save a little bit and spend money a little bit, you could really amplify the performance of your investment. You could change what's a 30-40 year goal to say 15 to 20 years just by having that alternative way of saving. And it doesn't really, you don't really have to change what you're doing in terms of work or anything like that. It's just literally about changing the way you save money, because the bank doesn't pay you anything for saving at the bank. So you might as well save money where the bank saved the money. If you want to learn more about the concept that I just explained on how to maximize the performance of your investment accounts and your retirement accounts, you could click in the description link below. There's a link tree where you could book a discovery call with me and ask me any question you want, or leave a comment below. And I will also be leaving a video, or link a video to the end of this, where it deeply describes this concept in detail on all the different types of moving parts on how it works and how you could amplify the performance of your investments and make money on your expenses. So if you want to learn more about that, either book a discovery call, leave a comment, or watch the video at the end where it detailedly describes how that concept works. I post content like this every single week, so if you're interested in different types of concepts, like different types of financial concepts and financial products, subscribe to this channel, Financial Ownership. Thank you.